All right. Well, I'm sure ladies and gentlemen here have a lot of questions for Udayan and our panelists as well. So let's quickly move on and invite our first guest on stage. Please put your hands together for Nirmal Jain of IIFL.
Good morning and a very warm welcome. I think the audience here shows that the bull market is still strong. Udayan has already set the tone, and I think I can't agree more with him when he says that don't look at the short-term charts and try to predict the market for 1 month or even 1 year, but have a horizon of a little longer term. I'll take you through the fundamental undercurrents, and then obviously we say that when you invest in equities, you don't invest for 1 month, 2 months, but you can allocate certain assets to equities, and that allocation can go up or down based on the market sentiment. There's a lot of talk, a lot of disappointments, a lot of voices now that the Modi magic has gone. Things are not as good as people anticipated. So there's a background, and I think the key problem has been that corporate earnings have not turned around, have not really come back. In fact, FY15, we are almost 0% corporate earnings growth, and FY16 also there have been a series of analyst downgrade. As Udayan rightly said, that most of them always start with say 15% plus minus 2-3%. So they're always wrong in 1 year, but when you look at a 4 or 5 year compounded average growth, I think there's a trend line that we'll always witness. At this point in time, as we speak, India may be at the cusp of new business cycle. When markets or a quarterly earnings don't show up, people get disappointed, and the sentiment is like a pendulum which swings from extreme optimism to extreme pessimism. But we can look at the hard numbers. Macro numbers are improving. GDP is growing. Even in the new series, one can discount it, but still year to year, quarter to quarter, we are seeing uptrend. Fiscal and current account deficits are well contained. Inflation and interest rates are going down, and several other industry indicators, whether it's a diesel consumption or power consumption, they are all moving up. Corporate earnings are depressed and they are cyclical low. They are likely to grow by 6% in FY16 after just growing by actually something like 0.3 or 0.5% in FY15. And consensus estimate for FY17 is around 17 to 19%. In fact, we saw some turnaround in Q1 FY16, and it looks like that corporate earnings will start looking up. Industrial capex and rural consumption, that remains weak. And as I said, consensus earnings growth for FY17 is likely to bounce back to 19%. There may have been disappointing few years, but I mean, if the long-term story of India is intact, I'll catch up with the trend line growth sooner than later. The most interesting feature of this year has been domestic money coming back to the market. And little contradistinction to 2008, when FI money was also coming in. 2015 was probably the first year when we did not see significant inflows of FIs. In fact, if you look at FI flows, they have been around $18-20 billion per annum. And if you look at FY15, the first 11 months, they've been just like $3 to $4 billion. And despite that, exclude this year, FI inflow as mediocre as this would have led to a significant fall in the market. But thanks to domestic money, markets have held firm and have not given away. We saw 71,000 crores of net inflow into equity in FY15, and in the first 7 months it's already crossed 60,000 crores this year, which is a good sign actually. All of us for last 15-20 years we've been driven by FIs because we think that the FIs and investing market will go up. I think this is the first year when we are seeing that there's a strength of domestic investor which can be significantly stronger than FIs. See, FIs have been investing $18 to $20 billion per annum on an average. And if you look at our domestic economy and savings, they're in the range of $400 billion plus. So there's a significant strength, and that can give stability to the market. For a 5 to 10 year growth story, Indian markets are not very expensive. It's a forward P multiple of 15 and a price to book of 2.3 times, which is in long-term averages. I think near-term triggers for the market, again, they are triggers for 100 to 200 point Nifty, but they won't change the underlying trend. But of course, they are GST bill and corporate earnings and maybe the budget also. Macro trend, GDP growth is bottoming out and moving up. fiscal deficit is narrowing. Fuel subsidies are down significantly thanks to crude oil prices being lower, and India is the biggest beneficiary of that. Current account deficit is also narrowing, inflation is falling, interest rates are declining, and rupee relative to other emerging market is fairly stable. Bank loan growth has been at multi two-decade low at 10% YOY. 70% of Indian banking sector is with public sector banks, and they don't have capital to really grow. Also, the capex cycle has been down. Gross capital formation for last 3 years has been almost zero. So I think bank loans will take some time to pick up, but the way it will happen is first public sector spending or public sector capex moves up, and that will drag or will drive private sector as well. Consumption growth is likely to remain slow. This government has been prudent but not populist with price increase in MSP and also the spend in the rural area, and that is likely to that will not provide the impetus to rural consumption which was there in the earlier years. Household savings is likely to go up, but the interesting thing there is their share of financial savings in household savings has dropped from 48% to 35%. If this bounces back to 48%, then we'll see a significant revival in the equity sentiment. Gross tax collection in this year has been very robust, 23% growth, and which is a very good sign. Fiscal deficit will remain under control, and this will give government leeway to increase expenditure for public projects. Key industry trends, in fact, Udayan touched upon this, that a lot of money has flown into pharma and IT, which are defensive sectors and may be overbought. But if you look at cement, volume growth is likely to remain flat in FY16, but will pick up in FY17. And therefore, people who are 2 to 3 year horizon can look at these sectors, which are relatively immune from the global commodity cycles and can be a play on Indian infrastructure, which everybody knows that has to revive, and even government's focus is there on them. Coal consumption has gone up, coal production has gone up significantly, and I think this will lead to lower imports, which also is good for current account deficit in a positive macro. Capital goods inflow and execution, we are seeing that that's also improving and will pick up. It has been a bit disappointing in the last 18 months, but there's no musical wand which any new government can have. But I think most of the things are moving in the right direction. So if you talk to road sector, railways, energy, or renewable energy, or defense, then most of them have started getting orders, and also the project execution there has picked up. Two-wheeler volume growth has been 4% in FY16, but is likely to move up to 11% in FY17, and this will give some pricing power to two-wheeler manufacturing companies. Passenger car also had a bad year in FY13 and FY14, and that's why we saw strong rebound this year, led by Maruti Suzuki. And whenever there's a volume growth, most of these companies have high operating leverage, and their profitability grows faster. Commercial vehicle is one segment which is just turning around, and I don't know how many people noticed in FY15, Ashok Leyland was the best performing stock, and this is one sector where there are deep cycles. It sees negative growth, and when it bounces back, it sees very strong volume growth, and profitability growth is significantly faster than that. Commercial real estate has also started moving up. Residential is now quite, it had a good time last 2 years when commercial real estate market was down. Other trends, we see that advertisement revenue is moving up slowly but surely. Mobile revenue growth, which are lower, not good for telecom companies, but this sector will see a lot of competition. Growth will accelerate, but not too significantly. There are other indicators. What we see of the retail consumption or demand are quick service restaurants, companies like, and airline passenger traffic. All of these are showing very good signs of revival in last few months. We are also seeing the road traffic and the freight moving up, and you see that the toll collection of the revenue growth of toll in the first half was 14% up YOY. In fact, we talk about corporate and earnings growth being down, but we exclude commodity companies, then we see that the picture is not as bad as is painted out to be. And we'll see PAT growth excluding commodity companies of something like 8.9% in FY16 and 21% in FY17. Household savings and equities are rising and should rise. And as I said earlier, I think this can be a good long-term trend. Why I'm more positive, I mean, we deal with million retail customers. The trend in 2015 has been a little different. A lot of money has come through mutual fund, which tends to be more stable compared to direct equities, where many retail investors get into small cap, mid cap, highly volatile sector, and they can't stomach the volatility and they end up losing money. But this time, a lot of household money has come through mutual fund, and we are seeing a lot more stable environment there. And this has come against the current of FIs, which in a way is good sign. FI inflows have moderated. I mean, they have been negligible and a very small $3 to $4 billion this year. As I said, that from a long-term investor's point of view, if you are investing at least a 5-year horizon, what matters is at what valuation you are getting into the market or getting into particular stocks. So if you look at our PE multiples, they are not significantly higher than the long-term average. They are plus minus 1% standard deviation. And if you look at price to book multiple also, we are significantly lower than long-term average. In terms of sectoral recommendations and in financials, in fact, NBFC sector is doing much better. Banks have a worry. Most of the PSU banks, we are still not very sure. And in fact, there are multiple problems. One is the base rate is recomputed, so many banks will be forced to pass on the 125 basis point cut that RBI has done, which is not good for their margins. And also there are a lot of NPAs still, maybe they have not come out, and I think that, so one has to be cautious. Even in private sector bank, one has to be cautious in terms of which banks you are investing in. There are banks which are retail focused. I think they are better placed. Till the dust settles, one can be a little, maybe keep away from the larger private sector banks where there are large projects and large borrowers and NPA risk. Auto sector is playing on falling interest rate and soft oil prices. I think this sector should continue to do well. Some of the companies like Maruti valuations are rich. One can stay invested or wait for an opportunity, depending on type of investment style you have. Cement, again, if you have a 1 or 2 year horizon, at least you'll see pickup in this sector. Industrials, rising business confidence and proactive government policies augur well for this. There are new orders and faster execution. In this, and that is happening, and we are seeing that at the ground level. And I think that will show up in corporate earnings with a lag of 1 or 2 quarters. What we are not very bullish on are underweight sectors, consumer staples. Consumption is likely to remain weak. This government is not throwing away money in rural sector, so there's a transition phase in which you'll see a demand slowdown. Pharma, again, may be underweight at this point in time because valuations are rich and there are a lot of headwinds from US FDA issues. But if the stocks correct, this is a good long-term defensive sector which gives you steady return over longer term. Metal, again, in fact, Udin pointed out that this may be a contrarian bet, but at this point in time, we would rather wait and watch how global demand and prices stabilize. I think the way things are happening today in China and as well as developed world, it may be a much longer term down cycle, and there's excess global capacity of metals. So metal prices may remain soft for a very, very long term. So this cycle can be much longer than the cycle that we have seen earlier. Because in the earlier cycle, the one significant factor was China was growing rapidly, and China was the biggest consumer and importer of metal. PSU banks, again, underweight because asset quality woes have not yet fully peaked, and maybe one should wait and watch how things pan out there. Telecom, again, highly competitive sector. Many telecom companies will have a huge payout for spectrum next year. Reliance Jio will intensify the competition, so stay away from this sector. These are our research recommendations in case people want to have stocks. Large caps are underperformed because FIs have been not investing, and a lot of money has come through domestic mutual fund and domestic investors. They tend to invest in mid cap, but I think you can make at this point in time. So relatively, large caps are not significantly expensive compared to mid caps. So you can make a balanced portfolio. You can have HDFC Bank, L&T again, infrastructure revival. This is one of the best plays. Maruti Suzuki, stay invested. SCL Technologies in a large cap stock in tech sector. Yes Bank, and then in mid cap you have Mindtree, KEC International, which is power transmission and T&D sector, Blue Star, CCL Products, and Simplex Infra. So these all, you can see the research that's there on our website, and most of our clients have access to. Thank you. Thank you.
Thank you, Nirmal. Well, next up, please put your hands together for Vibhav Kapoor of IIFL.